So one of the biggest things that can affect the housing market is interest rates. Higher interest rates mean higher mortgage rates, and higher mortgage rates can have a huge negative impact on home prices. When rates are lower, home affordability goes up. This means buyers can buy a more expensive house because they can get a bigger loan. When we have lower rates, we see a larger buyer pool, and when we have a larger buyer pool, prices go up. But it's the exact opposite with higher rates. When we have higher rates like we do right now, home affordability goes down. This means buyers can no longer qualify for the current purchase prices. Buyers can't afford to spend as much money on the purchase price because the monthly payment goes up. When rates get higher, buyers are squeezed to the point where they can't afford the current purchase prices. This means we're going to have a smaller buyer pool, and when we have a smaller buyer pool, prices tend to go up. So thinking about it this way, when a buyer is going to buy a home and they're using a bank loan, they're basically buying a home based on their monthly payment. So let's look at how interest rates affect the monthly payment, because that's really the nuts and bolts of everything. I wanted to take a look real quick at this graph because it does a really good job of showing just how much the buying power drops when interest rates go up. This graph is based on $1,100 monthly payment, but it's only the principal and interest payment, not the escrow for your insurance or taxes, just the P&I portion. So if you had a rate at 4.75 and you wanted to keep a payment at $1,100 for P&I, you could purchase up to a $175,000 house. But if that rate goes up just 1%, you drop down to $156,000, which is a $19,000 drop. And if that rate goes up 2 full points to 6.75%, then you drop down to $140,700 for your purchase price. That's almost a full 20% difference. And to me, that is huge. And this is exactly what's happening right now, but for a lot of people it's even worse because we're experiencing even a higher increase in interest rates than even this is showing. So when a buyer decides to buy a home and they're not going to be paying cash, the first thing they're going to have to do is get with a lender and fill out a loan application. The loan application is going to go over all their income, all their monthly debts, and one of the biggest things that the lender is going to figure out is what we call the DTI ratios, or the debt to income ratios for the buyer. And this is one of the most important things when it comes to qualifying the buyer for a purchase price. In order to calculate your DTI ratios, you're going to need to know your gross monthly income and all your monthly debt. Your gross monthly income is the sum of everything you earn in 1 month before taxes or deductions. This includes your base monthly income and any additional commissions, bonuses, tips, or investment income that you earn each month. Monthly debts are recurring monthly payments such as credit card payments, car payments, student loan payments, or personal loans, alimony or child support payments. But luckily, it does not include expenses, monthly expenses like your car insurance, cable bills, cell phone bills, health insurance costs, groceries and entertainment costs, and you only use your minimum payments for your DTI ratios. If you pay extra each month, you don't include that. You only include your minimums, like whatever it says on a credit card monthly bill, whatever your minimum, that's all you're going to include for your monthly debt. Debt to income ratio is a percentage of gross monthly income that goes towards paying debts and is used by lenders to measure your ability to manage monthly payments and repay money borrowed. There are 2 kinds of DTI ratios, the front end and the back end. So the front end ratio is a percentage of income that goes toward your total monthly mortgage cost, like your principal and interest, your insurance, property taxes, and so on. So the back end ratio is a percentage of income that goes toward paying all reoccurring minimum monthly debt payments, plus the monthly mortgage costs covered in the front end ratio. It does not include any utilities, living expenses like groceries, entertainment, gas, cable bills, cell phone bills. It doesn't include any of that. It's just minimum debt payments. Now, each loan type has their own DTI ratio maximum percentage that they allow. I just want to look at 2 quick examples, one for FHA and VA. Now, FHA loans have a top ratio of 31% and a bottom ratio of 43%. And VA, they do things differently, but their bottom end is 41%. Okay, the last thing I want to look at before I wrap up this video is this chart here on the monthly mortgage payments. And this is just P&I payments, no escrows included. But on the left here, we've got the loan amounts, and on the bottom, we have the actual interest rate. Let's take a look at a $400,000 loan amount and start out at 3.75. Your P&I payment is $1,852. Now, if we jump up and that rate goes up 1%, your P&I payment goes up to $2,087. And if it jumps up another point to 5.75, then it's going to go up to 23.34. And if we go all the way up to 6.75, so if the rate went up 3 points like it has in the last year, your P&I payment is going to be $25.94. That's over $700 difference, and that's big. So hopefully you can see from this chart exactly how, with the rates going up, it affects the payment so much, it just knocks buyers out of being able to buy more expensive homes. And this is a perfect example right here.